Warren Buffett, the legendary investor who's been in the game for nearly 80 years, is no doubt a name that's known to everyone. He's been investing since he was just 11 years old, and his vast experience and expertise make him the perfect candidate to impart wisdom to the new generation of investors. So, in this video, we're going to dive into some of the most common mistakes that every investor makes according to the man himself. Trust me, you don't want to miss out on the biggest mistake that could be costing you the big bucks. Stick around till the end and let's get started. Timing the market. The Oracle of Omaha didn't just stumble into his multi-billionaire status by simply timing the market. No. This investing genius takes the time to dive deep into companies and their performance, always favoring a long-term approach instead of trying to ride the wild waves of the market. He's the ultimate value investor, always on the lookout for those hidden gems that are priced too low compared to their actual value. And boy, has this strategy paid off. Just take a look at his impressive portfolio, including massive positions in companies like Apple, Bank of America, American Express, Coca-Cola, Dairy Queen, HP, and the list goes on. According to the man himself, one of the biggest mistakes investors make is spending too much time worrying about the market's performance rather than focusing on the fundamentals of individual businesses. I mean, let's face it, no algorithm or planning in the world could have predicted the chaos that the pandemic or the Russia-Ukraine conflict has induced. So, trying to time the market is like trying to catch a wave on a rainy day. Near impossible. This is where Buffett's investing philosophy comes in. He urges investors to focus more on the things that are important and knowable, such as the fundamentals of a business, its past performance, and whether it's well-equipped to handle future headwinds. Because at the end of the day, it's these factors that really matter when it comes to long-term investing process. Missed opportunities. Now, there's a common belief among investors that the most significant mistake one can make is the one that results in a financial loss. But you know what? According to our friend Warren Buffett, missing an opportunity can be even more costly and detrimental to your investments. These are the investments that you knew had potential, but for some reason you never took action. And let me tell you, if Buffett had acted on all the opportunities that presented themselves to him, he would have raked in a whopping $10 billion in profits. So it's safe to say that missed opportunities can be seen as a lost potential and can have significant impact on your long-term investment returns. The tricky thing is that it can be challenging to determine missed opportunities, which is why staying up to date with market trends and developments is crucial. Conducting in-depth research and analysis is also vital, as is knowing when to act on opportunities that arise. Because let's be real, opportunities missed can no longer be brought back. What matters is that investors learn from these missed opportunities so as not to make the same mistake again. Selling too soon. In line with his investment philosophy, Warren Buffett prioritizes longevity when it comes to investing. He strongly believes that investing in businesses with great potential is a smart strategy as it allows investors to benefit from their long-term success. Buffett notes that owners of profitable franchises, farms, or apartment buildings tend to hold on to their businesses for a long time, despite economic slowdowns or fluctuations in the market, because they understand their true value and potential. Therefore, he suggests that stock owners adopt a similar mindset when investing in stocks. Investing in stocks means owning portions of businesses, and just like owning a physical business, it requires a strong mindset that is not influenced by short-term market fluctuations or industry changes. Instead, investors should focus on the long-term success of the business they are investing in, rather than short-term shifts that may distract from the bigger picture. Buying cheap. Despite his early investing career, Buffett sought out low-priced investment opportunities with great potential. He invested in companies with low price-to-earnings ratios or undervalued assets and profited from these investments. However, he later realized he wasn't earning as much as he could be. He advises investors to buy excellent businesses at a fair price rather than fair businesses at an inflated price. This became Buffett's new successful investment strategy, focusing on businesses with competitive advantages, outstanding management, and long-term growth. He believes these businesses will generate high returns in the long run. This practice highlights Buffett's conviction that investors should concentrate on long-term investments and not on short-term market fluctuations. Investing in the right business will yield greater returns and a more stable portfolio. Investing in airlines. Buffett advises investors to avoid investing in airlines as he learned from his mistake of investing in them during the late 1980s. He had bought stocks in US Air, which unfortunately faced financial trouble soon after, putting his investment at risk. Airlines are not worth investing in due to the industry's unpredictability and susceptibility to external factors such as weather conditions, global events, labor negotiations, and fuel prices. Due to huge upfront costs for buying airplanes and building networks, coupled with fierce price competition that lowers profit margins, making it difficult to sustain capital investments, especially during economic downturns when demand for air travel dips. Despite this, many investors still put money into airlines, perhaps driven by the allure of air travel and the belief that next time would be different. Buffett's warning in 2007 was about avoiding the trap of this belief and investing in more stable and successful businesses. Not having a strategy. Buffett's investment philosophy emphasizes the importance of taking advantage of every opportunity, no matter how small it may seem. He believes that even small actions can lead to great results, and consistency is key to success in investing. Failure to have a clear strategy can lead to missed opportunities, so he advises investors to start with small investments and compound their returns over time. Similar investments may not seem significant in the short term, but over time, disciplined and consistent investors can accumulate significant wealth. By being patient and strategic, investors can achieve remarkable success in the long run. Not buying Amazon stock. Buffett acknowledges that not investing in Amazon was a mistake. Although he admired the company, he felt that the price was too high compared to the model's potential, and he did not fully understand how the business worked. However, he now wishes he had invested in Amazon, and this mistake emphasizes the importance of understanding a company before deciding to invest. Investors must study and analyze the nature of a business to understand how it works, and it's essential to establish relationships with experts in different fields to ensure every opportunity is taken advantage of. Business people also know when to make partnerships and with whom, allowing them to make the most of every opportunity that comes their way. Overtrading. In bull markets, some investors tend to overtrade, which can ultimately result in more significant losses. Buffett believes that a more calculated approach is necessary instead of trying to make quick profits. He recommends the punch card system, where investors should ask themselves if a potential investment is worth using one of the limited punches available. If an investor only had 20 punches in their lifetime, would this be one of them? Once all the punches are used, they cannot make any new investments, which forces them to hold on to their current investments and make more deliberate decisions. Following the crowd. Investors tend to make irrational decisions when they follow the herd mentality, leading to significant losses. To avoid this, Buffett advises investors to maintain an objective view and not get swayed by the crowd. They should invest in companies that have a long-term vision and the potential to withstand market volatility. Unlike many investors who are more active during bull markets, Buffett prefers bear markets because he can use his built-up cash to purchase undervalued stocks. He stays loyal to his strategy and does not let the crowd influence him. As Howard Marks, another investing giant, warned, popular trends are almost always wrong, and investors must be cautious about blindly following the consensus. Not diversifying or diversifying too much. Diversification can be an effective management investment risk, but it is crucial to use it properly. To add value, diversification must introduce assets with different risk profiles. For instance, when diversifying a portfolio of U.S. stocks, it is essential to consider non-correlated markets like gold, real estate, commodities, bonds, and other asset classes. However, diversifying blindly can be detrimental to your finances, such as adding more assets with a similar risk profile until your investment performance replicates the averages. This is known as diversification. Therefore, when diversifying, the goal should be to add independent and opposing sources of return to lower portfolio risk and possibly increase overall return when coupled with other investment techniques. As the famous saying goes, wise men profit more from fools than fools from wise men. For the wise men shun the mistakes of the fools, but fools don't imitate the successes of the wise. Thus, it is essential to make informed decisions when diversifying and avoid blindly following the herd mentality. Missing the forest for the trees. Buffett suggests that investors should not focus solely on the details of Berkshire's individual businesses, which he calls economic trees. but rather look at the bigger picture, or the forest. Since Berkshire owns businesses ranging from small twigs to large redwoods, he divides Berkshire's holdings into 5 groves, including non-insurance businesses it controls, marketable equities, controlling interest in other businesses, cash and fixed income instruments, and its insurance business. Buffett believes that the non-insurance businesses controlled by Berkshire are the most valuable grove in the company's forest. The runner-up grove is its stake in marketable equities. He stresses the importance of these companies using retained earnings to repurchase shares, stating that he rejoices when management employs some of its earnings to increase Berkshire's ownership percentage. American Express is an example of a company that has remained unchanged in Berkshire's holdings for 8 years, but its ownership has increased from 12.6% to 17.9% due to share repurchases, indicating the effectiveness of such strategies. Expecting history to repeat itself. Just because your investment advisor told you the average historical returns from the US stock market are approximately 10% annually, or 7% or 8% depending on time period and whether adjusted for dividends and inflation, doesn't mean you should expect similar. The future will be likely different from historical averages, and your average holding period may not be long enough to replicate average returns. For example, most long-term historical stock return studies use average holding periods of 30 years or more. Even if your investment career is 30 or 40 years, your average holding period will likely be less than half that length. The bulk of your savings are usually accumulated late in your career and spent throughout retirement. Almost nobody begins investing at age 30 with a large lump sum and retires at age 60 on that investment to create a 30-year holding period. Life doesn't work that way. The result is you should expect far greater variability in expected returns than long-term averages would indicate. Additionally, average returns are a statistical fiction that seldom exist in reality. According to Nassim Taleb, author of Fooled by Randomness, the average return on the Dow Jones Industrial Average from 1900s to 2002 was 7.2%. Only 5 of the 103 years had returns between 5 and 10%. Obviously, the average is far from typical. Not investing in your financial education. Investing in yourself is crucial to achieving success in the financial world. Every investment you make in your own education and development will pay off in dividends throughout your lifetime. Investing is a complex process that requires both an artistic and scientific approach. It is important to be skeptical of simplistic half-truths that do not respect the complexity of investing. Investing is an art because our decisions are influenced by our emotions, values, previous experiences, and more. It is important to recognize and balance these factors to make the best decisions. Investing is also a science because it requires knowledge of principles such as diversification, asset allocation, correlation, and probability. A successful investor must balance both art and science to consistently make profitable decisions. It is important to continually work on yourself and develop your knowledge of investment strategy. Have you made any of these mistakes in the past? Let us know in the comment section below. If you learned something from this video, make sure to like it, subscribe to the channel, and ring the notification bell for more videos like this.